Hey, it's Rav. You're watching Real Investments, the hottest real estate investment show in the world. That's right, I said it. I don't care who knows it. We have got a fantastic show lined up. We've got my good friend Carmen Caponero on the show. She is the one where we get money from. She's the one that helps us to make money with our money. Remember, whenever you're investing in anything, always ask 4 questions. Get your paper out, get your pen out. The 4 questions to always ask when you want to invest in anything is: number 1, what is the return on my investment? Number 2, when do I get that return along with the principal? Number 3, what is the investment amount needed? And number 4, what is the risk? Today we're going to be talking about syndicate mortgages, private lending, how I as an investor, Rav Tour, can be able to borrow money and invest it somewhere else, and you can too. How I can lend money and make 12, 13, 14, 16% on it. We're going to be talking about all that kind of stuff. And like I said, there's no one that I'd rather be speaking to than Carmen Caponero. Carmen, thank you so much for being on the show.
Thank you for having me.
It's so wonderful to have you. Each week I have the privilege to be able to do the Mortgage Minute with you.
Yes.
And be able to hear your sweet voice on the phone, but it's obviously better that I get to have you on the show.
Absolutely.
You are the chief of Profunds Mortgages. It's been around for a long time. You've made a lot of people money. You've made yourself a lot of money in this whole world of mortgages. What do you love about it so much? You're always go, go, go. You got beautiful children. You're spending time in Florida. You're traveling. You know, you're doing all this kind of stuff, but you always love talking about making money in the world of mortgages. What's your drive? Where does it come from, do you think?
I think the ultimate drive there is what's behind it all, and it's real estate.
Yeah.
And I've had a passion for real estate since the beginning of time. At 18, I started investing in my first property, and it just continued from there. So knowing that this investment vehicle is geared to security on real estate, that gives me comfort, and it's very exciting because real estate's an amazing investment.
It's interesting that you just said that, because a lot of times people, you know, they're watching this show is a real estate investment show, and here we are talking about money, mortgages.
Yes.
But mortgages is real estate.
Right?
I mean, it's great that you said that, because that's what drives it. Is obviously someone's got to purchase the land, somebody's got to be able to pay down, you know, somebody else's property. All that stuff has to do with money. So whether I'm borrowing it as an investor, whether I'm lending it out as an investor, whether I'm doing it with a bunch of people, syndicate mortgages, whether I'm pulling money out of a property to do another one, it's all real estate related.
Yeah, it's all backed by the real estate and secured on real estate.
Yeah.
So, I mean, I love real estate. I have a passion for it, and it doesn't matter where I am. If I find real estate, and no matter where I'm visiting, I always want to buy it. It's that bad. It's addictive.
You just bought one recently in Florida, a beautiful property in a gated community, and you're refurbishing it, and then you're going to flip it and make money like you always do?
It's an investment through our company, so it's something we're dabbling in, and I'm not one to really get out of my comfort zone of being in Ontario, or Canada, I should say, because we invest all over Canada. But I like to stick to my own backyard, where I know the market really well. This is a test to see what it's like over there, because I'm hearing so much about Florida, and so many people, oh my gosh, we got to get into the Florida market. Yeah. So we're testing it out. We're learning the whole process down there, how it works, and then maybe we can implement something later.
Mutual friends of ours, I know you're close to Michael Saraceni, you're close to Scott McGilvery. They have properties right where you've you know, bought a property. So I think that's the good thing about kind of having an investor family, and that's created with Profunds Mortgages as well. There's tons of investors. Turnkey opportunities where we, you know, where we can lend money and be able to receive money to be able to do ventures that you put together. So talk to me a little bit about the marriage between Profunds Mortgages. You also have kind of a a developer wing of your division called Valor Capital.
Correct.
Mark Vasilius, you know, kind of helping out with that. He's been on the show. Talk to me about that kind of marriage and that arm.
Okay. Well, what happened is that, Profunds has been established for many, many years. Yeah. And we've been really focusing our attention on private lending for the last 10. And there's a real niche in the market for it. There's a huge need because of the mortgage rules that have changed so dramatically. There's this large opening for individuals, and you don't have to be a millionaire to do this. You can start off with $25,000. And
so if I have $25,000, I can lend that out. Is that what you're saying?
Absolutely.
Okay.
So, and if it's an RSP or even if it's cash, whatever, and we can go through the whole process of how that works in the different vehicles. But so what was happening was there was such a demand opening for this, and a lot of developers, construction, this type of thing was coming to us for a larger amount of funding required. So this is where the pooling or syndicated funds was established, and you have to really do your due diligence on deals like this. And I know the business very well, and I have my own projects, but there is no way I'm going to undertake analyzing projects of that caliber and inherit all that risk, because I want to make sure our clients are safe. That's so important for us.
And you know, we'll go to a break here, but when we come back, somewhere in this show, I want to talk about the risks. And what I love about you, Carmen, is, you know, you tell people, here's the deal I'm offering you, but here's the risks, and you let people make their own decisions, as opposed to, you know, kind of spinning it and all that kind of stuff.
We have to be factual.
We'll talk about that when we come back from the break. You're watching Real Investments. You don't want to miss this show. We're talking to Carmen Campanaro about how we can make money on our money. Real Investments continues in a moment. Whenever you're considering to invest in real estate, always ask 4 questions to start. Number 1, what is the return on my investment? Number 2, when do I get that return along with the money that you put in? Number 3, what is the minimum cash amount needed? And number 4, what is the risk, the worst case scenario? Hey, it's Rav. You're watching Real Investments. Today we're going to be talking about how to make money with our money. Lending my money out, I can make some great money. Borrowing money and putting it somewhere else, I can make great money. All that kind of stuff. Carmen Campanaro from Profunds Mortgages is here to talk to us on how we can do that. Carmen, it's always great to have you on the show, not only because you teach me how to do it, but because you also are an investor. You lend money out and you make money on it.
That's right.
You borrow money and lend it to and invest it in other places and make money on it. So we're going to talk about all that kind of stuff here on the show. But before we do that, you were touching on the risks and how we have to be very careful, especially in the syndicate mortgage world, where there's developers right now that are needing to borrow money, great developers that are needing to borrow money because the banks are very tight, and it can be very lucrative, but we've got to be very careful. So why don't you go down that road a little bit? I think the industry that regulates mortgages, FSCO, what does that stand for?
It's Financial Services Commission of Ontario.
Financial Services Commission Ontario, FSCO.
Of Ontario, yes.
Okay.
So they regulate the mortgage brokers in Ontario.
Okay.
So it's strictly Ontario.
And they just posted something.
Yeah, there's been a notification, and I only mention this because, you know, it's our objective to keep our investors safe. And if there's other people in the industry doing something that's not right, it really has an effect on everybody as a whole. And it's our first priority to make sure our investors are in a good place, they're informed, they understand their risks, and so on. And so what's been posted, there's a caution notice just to say, you know, if you are getting involved in syndicated mortgages, because it's becoming more popular now, a lot of people are jumping on that investment vehicle.
Yeah.
And then, you know, we've been doing this for a long time, but now all these new companies are popping up doing it.
Yeah.
And it's just a matter of being sure that the company you decide to invest with, make sure that the information that's delivered is accurate. And how do you know that? Well, you make sure that there's appraisals and things like that. The due diligence part of it is there. And secondly, you got to make sure that the people you're dealing with are actually registered mortgage brokers, because they're not allowed to trade in mortgages unless they're registered as a mortgage agent or a broker, and they have a number or a FSCO number, and it's registered online. So it's important.
Yeah, so let's teach me how syndicate mortgages works, just very quickly. So basically, a developer has a parcel of land. The land costs $5 million. He wants to build some townhouses on it, and there's going to be some marketing costs, and then there's the construction cost.
Yes, yes.
So he wants a couple $1 million from us. So Carmen goes to her investors, RAV included, and says, guys, pool your monies together. We're going to lend this developer $2 million. Where would that $2 million go? Does it go towards land? Does it go towards marketing? Does it go towards construction?
Yes.
Where does it go?
Every deal that we get is very different. And then, you know, that's what I was speaking actually about how this whole thing evolved, because there's so many projects and so many different needs for the money. So what we would do is analyze the whole deal, and it's quite an analysis. So that's when we brought Valor Capital into the picture, where we have a team now and I have partners there. It's Richard Hall and Mark Vasilius and myself.
Yourself, yeah.
And that team there really directs their energy strictly to development projects to make sure that the analysis is done correctly.
The numbers work.
The numbers work, because there's so many little things in there. If you don't have every little number in there, and if you're off, project could be a failure, and then we're all in trouble.
But before I know that before I invest, I'm going to know where my money is going, whether it's going towards the land, whether it's going towards the marketing, whether it's going towards the construction.
Correct.
And it's always registered on the land.
Absolutely.
It's always secure.
When we finish with a package, and actually I'll give Richard the credit for this one, because he created something called a MIO, a mortgage investment offering, which we're going to, in the process of...
He originated that?
Yeah.
Really?
We're in the process of trademarking it, or...
Mortgage investment offering. MIO.
Yes,
okay.
yes. It's in the process of being registered. But that basically is like an offering memorandum, not as large and onerous as an offering memorandum, but at least it's a full disclosure to investors on what is going on in this project.
Okay.
The risks involved, you know, the numbers, who the parties are. I mean, the package is substantial.
Okay.
So our investors will get this package. And if we approve the deal, and believe me, it's a very large process of getting through, and if there is an approved deal that comes through our company, we're very selective. We don't take them all. It's not about the dollar. It's about making sure our clients are safe. What we do is we say, okay, to our investor base, this is what we're offering right now. If you're interested in using your RSPs or cash or existing equity in your real estate to invest, you can take the funds, and we typically start about a $50,000 minimum investment.
$50,000 for the syndicate mortgages.
For the syndicate mortgages. Now, in some cases, if it's a smaller syndicate, we offer $25,000. If some people are just wanting to get their feet wet and see what it's all about, then we will allow for $25,000.
Sure. It's negotiable. You're the one that's in control there.
It's just difficult because you've got so many people and it's a lot of paperwork. And so what we do then is everything goes through a law firm. So we will draft all the paperwork, and there's a lawyer that we actually pick to use for the group of investors. It's their legal representation. Yeah. So it is their ILA. They have a lawyer representing them. And then at that point... ILA, independent legal advice?
Okay.
Correct, yes.
Yeah.
And so what happens is then The monies are all provided to the law firm.
Yeah.
Okay, so nothing comes to our company.
So it's not like we're giving money to Profunds or to
Carmen.
Valor or to Carmen. It goes all to the lawyers.
Yes.
Then the lawyers give it to the developer.
That's correct.
And we know where it's
Well,
going.
what happens is the lawyers then do their searches. They make sure that there's security, because this is a mortgage investment.
Yeah.
It is registered on the title of the property. That's our security. That's why this is such an amazing.
That's why, because it's mortgage as
Yes.
opposed to, limited partnerships and all that kind of stuff. One doesn't have to be accredited. They don't have to,
Correct.
Make a certain amount of money or have a certain amount of net worth.
Correct.
Basically, anybody can take their RSP money or their cash money and invest it here.
Correct. Now, we also want to make sure that we know who our clients are and they're not taking their last
Of course.
pennies and putting it into this. And, there is some risk, which we're going to get back to that again.
Yeah.
But we're, the whole point is that this is a mortgage investment. It's secured on real estate. And that is the beautiful part of this.
Yeah.
And what happens is once it's registered, it closes. We have a company which is an administrator. It's a part of the Valor group of companies. And we are a mortgage administrator, so we actually direct deposit the mortgage payments into the investors' accounts every single month.
So that's what I was going to say. So now we're lending, Rav and Friends are lending the money to the developer, because we're still on the syndicate one, right? We're going to talk about, we're talking about syndicate mortgages right now. We're going to talk about private mortgages. We're going to talk about borrowing money. Rav, yours truly, would borrow money and invest it. I do it right now. So we're going to talk all about that. But right now we're parked on the syndicate.
Yes.
So Rav and Friends is lending the money.
Yes.
In return, just like if he was to do it with a bank, Mr. Developer is paying Rav and Friends monthly interest.
Yes, and what we do is we allocate an interest reserve for the term of the mortgage.
Okay.
Okay, so this specific, let's say, typically our terms are about 2 years.
2 years, okay.
So there's 2 years terms, and you will typically receive immediate returns 30 days after closing.
Okay.
So every month you're going to receive a mortgage payment.
Yeah.
So you're actually like a bank.
I'm the
Someone
bank.
else is making your mortgage payment.
Rav and Friends are the bank.
Yes.
And what's that return on investment? What is the number usually?
Our return is typically 16% a year, and we are, I would say, probably the highest paying syndicator in the industry.
16% a year?
Yeah, we
Do I get all that monthly, or?
No, we divide it. So 8% comes to you, now between 8 and 10, it depends on the project, they differ.
Yeah.
But 8% interest only,
Yeah.
paid monthly
Okay.
on your principal that you've advanced.
Yeah.
And then at the end of the term, you receive your principal back plus the lender fee of 8% a year.
Per year?
Per year.
So on this 2-year project,
Yes.
Rav lends $100,000.
Yes.
Okay, so if you're at home, get your paper and pen out. And we're going to lend out $100,000 to the developer. Now he needs a couple million, but there's 20 of us that lent $100,000 each.
Yes.
You're saying, Carmen, typically $50,000 is our minimums to get in.
Yes.
Okay. And you don't have to be accredited. Anybody can do this.
Yes.
And you can use registered money.
Yes.
Okay.
RSPs.
So to make the numbers,
RRSPs.
Lira,
RESP,
TFSA,
yeah,
RESP.
all of that, yeah, eligible.
So I'm going to lend out $100,000, and I'm going to make, in the first year, $8,000 paid monthly.
Yes.
So I'm going to get $700 a month, say.
Okay.
Then the next year, I'm going to get another $700 a month. So I get $8,000 in the first year paid monthly, $8,000 in the second year paid monthly.
Yes.
At the end of it all, when it's
Yes.
all done, I get my principal back, but I also get
A bonus, a lender fee.
a lender fee of $16,000 because it was another 8% first year, another 8% second year, which is 16% at the end.
That's correct.
That's what I'm getting.
Yes, and it's actually in mortgage lending, when the lawyers register the mortgage, there's something called a charge.
Okay.
And it's actually registered on the charge. So let's say whatever happens, the builder changes hands, it's a different builder proceeding. They cannot discharge this mortgage without paying that. Okay, so it's not contingent on the success.
It runs with the land. There's a charge on there. If some guy in and out, it doesn't matter. On the land, it says Rav and Friends is entitled to this much money.
And they're registered on the property as a mortgage, so they can't sell the property, they can't do anything unless they have consent.
Yeah.
And the actual terms of this mortgage is actually written on the charge of the deal. So if something happens and oh no, it's not that, it is actually all there in writing, and nothing can happen there.
So what was the definition you used? So
it's a charge.
No. I'm getting my 8% per year, paid monthly.
Yes.
And then at the end, I'm getting my big chunk, and that's called a?
Well, we call it a lender fee.
A lender fee.
Yes.
Okay.
And it's actually postponed or deferred to the end of the term.
Okay. So a deferred lender fee.
Yes.
Now, is that based on the profits of the project, or whether the project is profitable or not? Do I still get that?
So how it works is this with our specific program, and this is why we can pay the higher yielding returns, and it's not indicative of any additional risk, because it's a higher return. I hear so many people, oh, it's too good to be true. I said, no, it's not. There's a reason behind all of this. And market rates for private money is in that ballpark, so it's not that crazy. It's just the other people out there offering investments like this aren't giving investors what they should be getting, okay? Because second mortgage rates, typical throughout the industry for many, many years,
14, 15,
12,
16.
14, 15, 16%. That's the going rate. So it isn't a new thing that's been developed, and people just aren't aware. There's not enough information on private lending out there. So with this scenario with syndicated mortgages, we negotiate a deal with the developer. We may get a percentage, so Valor will get a percentage of the project's profits for bringing in the funding. They'll also pay the fees. So what we do is we give majority of the returns to our investors so that they can yield that type of a return.
And then you take the risk if whether it's profitable or not.
Well, see how it's structured is on title it's registered, so when they discharge the properties as they're being built, they're getting their fees added in.
Got it.
So whether the project is a success or not, they're getting their money. If the sales don't come in,
I'm still making 16% a year.
Doesn't matter.
Anyways.
So, and if the sales don't come in, the builder's the one that has the issue, and Valor will be the ones that don't make the money.
It's a contract, and it's Valor, and
they make the money first.
Got it.
And then whatever's left over, and in most cases, they're pretty lucrative.
And we're not going to be able to, share all the ingredients right here on the show, but people can call you, profunds.ca. Hey, Carmen, I'm interested. I want us to look at syndicate mortgages, because this is relatively new. When we come back from the break, we'll talk more about the privates and all that kind of stuff.
Great.
You're watching Real Investments. My name is Rav Tour. I'm talking to Carmen Campanaro. Don't go anywhere. We'll continue in just a moment. Thanks for watching. Did you know that mortgage investments are registered on the property title, thus providing tangible security? Mortgage investing is one of the safest, high-yielding investment vehicles available. This is why the banks do it. Hey, it's Rav. Welcome back to Real Investments. Today's topic is mortgages, the world of mortgages, how we can make money with mortgages, how we can make money lending our money out, and how we can make money borrowing it, whether it's in a syndicate vehicle, which is just another word for yourself and a bunch of people coming together, lending money to a developer, whether it's in private mortgages. You can also use registered money to do this, RSPs, RESPs, LIRA, TFSA, all that kind of good stuff. Carmen Campanero is here to talk all about that. It's so wonderful to have you on the show.
Oh, thanks.
We touched a little bit on the syndicate world. What I want to do really quickly is I want to talk about the borrowing, just quickly, because really what's really fun is the lending of money.
Yes.
Because, you know, I love lending my money and making my, you know, whether it's as small as 7%, 15%, all day long, usually 1-year term. So we'll do that. But I also want to touch on borrowing money, because I think people don't realize that, you know, somebody like myself who's been doing this 26 years, who's never lost a dollar real estate investing, I borrow money all the time. I borrow money from whether it's institutional, whether it's private. I borrow money, and if I borrow money at 12%, I know where to put it. You know where to put it to make 30%.
Yep.
And so if I were to borrow money at 12% and know that I can make, you know, 22%, then I'm making 10%, the margin, the difference, all day long.
Yeah.
And so, Carmen, can you help me? I know you can, but I want you to help with the viewers at home how it works. Because a lot of people say, oh, well, if this guy needs to borrow money, he must have done something wrong.
Yeah.
No, it's because...
I mean, that's the history of private lending, and that's, it all started, you know, many, many years ago, and that was, you know, people with derogatory credit or couldn't get a bank mortgage because banks were a lot more open to lending.
Yeah.
And really, bank financing was the only option to the average everyday people that didn't have tarnished credit and had income. The only reason you would borrow private money is if it was, you know, you're in a real pickle and there's something really
One of my companies went bankrupt, I just got divorced,
so
all that kind of stuff.
That's why these higher returns in private mortgages came to light. And then over the past few years, and I mentioned like 10 years now, we've been focusing on the private money. But when Flaherty's mortgage rules changed in 2008, it squashed a lot of investors' dreams of buying real estate and doing things, because 90% of us, well, in our company, are self-employed. So when we are dealing with individuals that are self-employed, that cannot show their income, they're not in this perfect little square box, you can't get a mortgage for an income property today. It's very, very difficult.
Yeah.
So it's opened doors for private money. So we fund a lot of deals to individuals.
Like
yourself,
me.
myself, I borrow private money all the time because I'm self-employed and I can't get a mortgage with a bank.
Yeah.
I could get a $7 million mortgage in a commercial division easier than I can as a $100,000 mortgage, and that's how crazy the
on a residential.
That's right. How it is in the mortgage market. It's crazy. So what we do is, and that's why our company is so different because we cater to real estate investors that are looking to buy property. We're not dealing with people in trouble that have bad credit, that need to consolidate, that can't get a bank mortgage because of their personal circumstance.
And I think that's very important for those of you at home who are investors, real estate investors like myself, that we can borrow money and we would gladly pay. Rav would gladly pay 10, 11, 12% on that money if I know I can make 25, 30%. So really that's what you're saying, is that you have a bunch of investors, Carmen, that come to you and they say, Carmen, find me people who want to lend me the money because I will gladly pay their 12%. You can secure it on my properties. You can secure it on whatever you want. It's all good.
They're great credit. You know, they're just business people. They can't show the income on their notice of assessments. And, you know, an example would be a client of ours who purchased a 12-unit building in Oshawa. It was a power of sale. It was vacant. She couldn't get a bank in there, obviously. So what happened was we got our first mortgage.
So why do you say obviously? So say that again.
Well, because it's a vacant property. There isn't income. Okay.
So whenever the bank looks at commercial property, this one had how many doors on it?
12, I believe.
12 doors,
12
okay?
doors, yeah.
So this was 12 doors and it was vacant. The bank says there's no income from it because it's vacant.
Correct.
We know as investors, all we do is put a little lipstick on it and all of a sudden we're going to put people in it. But she couldn't get the money from the typical bank.
The bank actually referred it to our company because I do a lot of business with them, and he said, you know, Carmen, maybe you can help her out and I'll finance it when she's finished doing the renos and putting tenants in. She picked it up for a great opportunity.
So what did you do there?
We put together, and syndicated mortgages will also work for something like this. So we put together let's say 4 people.
How much does she need?
It was 500,000.
500,000. So 4 people might have put in 125,000 each.
Yes.
Okay.
And what we did then is we took an interest reserve for the whole year, so she didn't have to worry about making mortgage payments.
Okay.
And she went in there.
So what does that mean, interest reserve?
Well,
so Rav gave her 125,000,
yes.
and for that year I didn't make monthly payments?
No, what happens is this. Our company is a mortgage administrator, so we will take interest for the whole period of the term.
Okay.
So we will take that interest, put it in our trust accounts, and we'll make the payments to our investors every month.
So you would have paid me?
Yeah, so we'll
Okay.
make sure that, but that gives you extra security to know that there aren't going to be NSF checks and everything's going to be made payment on time, things like that. So it works out really well. And then it also gives the person borrowing the money peace of mind that they don't have to run around and make payments to 4 people every month.
Great. So this girl,
Right.
Susie,
Yes.
Susie needed to borrow $500,000.
Yes.
Rav and 3 other friends gave her $125,000 each.
Yes.
Profunds put the whole thing together.
Yes.
The bank referred it to Profunds.
Yes.
The Schedule A bank.
Yes.
Carmen paid me monthly. What was the
We did, the interest rate was 10%.
10%.
For a first mortgage.
Yeah.
Interest only, so it was paid monthly, and a 2% lender fee.
14%.
14%,
So-
no, 12.
Oh, 10 and 2.
Yes.
So I made 12%
Yes.
on my 125,000, paid monthly, and it was only a 1-year term.
It was a 1-year term.
I love that.
Yeah, so that's the type of thing that we-
So this topic of conversation is not Rav, so let's get away from Rav. This is Susie. So Susie borrowed 500,000.
Yeah.
She paid 12%, 10 monthly and 2 as a lender fee.
Correct.
So she paid 12% total on the $500,000. She put it all in order. She tenanted it. She's making, I know she's making 30% plus a year. Then after year 1, the bank said, wow, we will give you now the mortgage at a preferred rate of 5% or whatever it was.
Yeah, and we have people buying land, so we finance that. I use private money in my own scenario, and we've discussed that at the events with the Sarancini event there, but you know,
you're always borrowing money to do things. And,
I found
pay
a
back.
great deal in Grimsby, Ontario. It was this beautiful commercial building, and I got it for literally $300,000 below market value, which was crazy, but I did.
Yeah.
So we closed with private money.
Why private, not the banks?
Because, first of all, when you're in with the bank, you have to consider the time involved with getting a commercial mortgage.
Yeah, it takes a lot of time, it's tedious, red tape.
And they're only going to lend to you the purchase price or the appraised value, whichever is less.
Got it.
So with a private lender, okay, he saw the fact, this lender I was dealing with specifically saw the fact that the appraisal came in at this and knew that the value was that. So he gave me almost 100%, and then I refinanced with the bank 3 months later.
So you're in for no money in.
Basically. Yes.
So for all the Susies out there that are watching, there's nothing wrong with borrowing money at 12% and making your 30% just for a year. Then you go to the Schedule A bank, and then you get the mortgage redone at the preferred rates of 4 to 6%,
Yes.
whatever it may be. Okay.
Yeah, so that was a great scenario of how you can use it.
So we touched on the syndicate mortgages,
Yes.
of how we pool money and we lend to a developer. We touched on how somebody can borrow money. So I can borrow money at 10, 11, 12%. I'll pay the person. And it makes sense if I can make 25, 30%, because that beautiful word called margin is basically coming to me.
It's the cost of doing business.
You know, every single month.
Yeah.
Basically, and it's not my own money. I'm borrowing, I'm making, and that's how the banks make their money.
And this having the ability to have access to private funding like this is buying power for people. You have so much control if you could say, Carmen, I'm looking to buy this property. It's an amazing deal. I need to close really quick.
Yeah.
Can you put this together for me, and can we close in 2 weeks?
Yeah.
Yeah, I can, but how much money have you saved with that?
And you know, I keep reiterating this, and correct me if I'm wrong, Carmen, but this is exactly how the banks work. The banks say, put your money in the savings account. We'll pay you, what is it, 1%, 2%? What is it?
2 if you're lucky, I
Okay,
think, right?
so let's just pretend
Yes.
we're lucky.
Yes.
So we give our money to the bank. It's in a savings account. They're giving RAF 2%, but then they're using my money, and they're making 3%. Or they're making 4%.
right.
They
They're
don't
doing
even, and they
that.
don't even want to make much because it's volume. So that little margin of the 1-2% is how the big banks make their money.
That's right.
And
But
so we're
they
just
deal
doing
with
the same.
massive volume, and that's why they're.
Well, we're doing the same thing.
Yes.
I will take your money. whoever it is, I'll take your money and I will give you 12% on it, but I know I'm making 25, 30%. And if you continue to watch the episodes here, that's where you can learn how you can make that.
That's right. There's a scenario with the Be the Bank, what we should talk about.
Yeah, absolutely.
That would be really good for them to hear.
So I think that's fantastic.
Yep.
I always say, what's the relationship? Because I always say the banks are the government, but I don't know why I say that. Do I say that because they pay big taxes to the government, or CMHC, or so?
Well,
when
they're just highly regulated, so
they're highly regulated by the government, I
Yes,
guess. Schedule A
yes,
banks, there's a lot to go there. But how does the government win with the Schedule A banks? How do they win? Do they win because the Schedule A banks pay so much in taxes, or what
you know
is
what?
it?
That's a whole different topic.
Yeah, and I don't even know. That's what I thought I was asking you. Maybe there's not, but I'm always looking for some sort of conspiracy. Although, listen, I love my government. I love this country. I'm born and raised.
I have some comments on that, but I think I'll refrain from them.
Yes, we won't talk about that right now. So now let's talk about one of the things that we love to do all day long, and we love to now be the bank. We love to lend money. So I would take my money. I would take my mom's money, you know, as I take care of her finances, and lend money out 1-year terms and her making the money. So talk to me about, you know, the people who need it. Well, we already talked about the people who need it aren't the people who are delinquent all over the place.
Yeah, that's not our direction. That's why our default ratios and risk levels are reduced with our lending vehicles because of where we're going with it all. Because generally in the industry, majority mortgage brokers are putting their privates into the typical deals, right? They're a little bit challenged. And I get a lot of other mortgage brokers packages in our office. We're quite known in the industry, and a lot of other brokers know we have a lot of private money available, so we're receiving a lot of other people's deals in the industry, but we decline, I'd say, at least 90% of them.
Because you want to make sure the numbers work.
We want to make sure. There's so much work involved in fixing the problem, which is something we can talk about as well. So that's why I don't want the problem. So we're going to just do as much as we can.
When you say fix the problem, means helping someone's credit, helping them to get better credit.
Fix the problem if there's a default, right, on a mortgage investment.
Got it. So if Rav lends money and there's a default, then you come in and you help me to fix that, to make sure
well, if you're my client, I'm definitely going to support you 100%.
Yeah.
And the type of deals, like I try to avoid that type of thing altogether.
Yeah.
It's time consuming, and I can find better things to do with my time than fix the problem. Let's put out more money that's going to be in a positive place, and then everybody's happy. So one negative situation turns people off. So.
And I know that you do a lot of lending money with other people too. You say, hey guys, I'm doing this. Does anybody want to join me?
Oh, well, I definitely get involved now. I've even got my ex-husband investing now. Now that's a good one.
That's funny.
It's true.
So Carmen,
Yes.
when it comes to lending money, the aspect of, you know, we talked about syndicates where it's $50,000, and you can use registered money. When I want to borrow, what's the minimum that I can borrow? We'll talk about that when we come back here from the break.
Yeah, we'll do the bank scenario.
Yeah,
I think it's great.
When we come back, we're going to talk to Carmen here about how we can continue to make money with our money. Don't go anywhere. Real Investments continues in a moment. Did you know that mortgage investments are fixed returns that form part of the registration on title, and they're always registered through a lawyer? The borrower cannot sell or further finance in advance of you without your consent. Won't acknowledge you. Hey, it's Rav. You're watching Real Investments. Today we're talking about how to make money with our money by being the bank, by lending out, by borrowing and putting it somewhere else, all that kind of good stuff. We need an expert to be able to teach us that. We've brought on Carmen Capernero because she is an expert, the money guru, if you will. Carmen, it's wonderful to have you on the show. Every time I'm with you, I learn so much. You are a very successful investor, and this is all you've been doing. I mean, you look young, but you've been doing this for, what, 20, 30 years? Your first property was in 19?
Oh, I was 18. So that was 10 years.
See, now you're giving
That
me
was
the
10
age.
years ago.
There you go. No, but you've been doing it a lot. And,
I have. It's 20
making...
years in the business.
Yeah, no, I think that's fantastic.
So,
you know, there's a lot of people that have been watching the show. Mm-hmm. They have their pen and paper out. The first question that I always tell them to ask is, what is the return on investment? And you're saying the return, if you're lending money out, can be anywhere in a syndicate to 16% paid monthly, 8% to 12% on private mortgages, sometimes even more.
Yeah, so we can actually go through that. So for, let's say you are just a private lender on a regular mortgage, which we call individual mortgages.
Yeah.
And if you're doing a first mortgage, the typical return would be anywhere between 7 and 10%.
Paid monthly.
And it's paid monthly with traditionally a 2% lender fee.
So
a lender fee, which means you, let's say for example, you're the lender.
Yeah.
The person borrowing is going to pay you a 2% lender fee. Up front on closing.
Wow.
And then you're going to get your 7 to 10% every month paid monthly.
And they're usually 1-year terms.
1-year term. They pay the legal fees. They pay everything.
Fantastic.
And they pay us for coordinating everything.
Yeah. And your fee, they pay
always
you another
match,
2%.
Yeah, we pretty much
me.
match you. Yeah. So we want to be fair for everyone and make sure that the rates and fees are fair.
Yeah.
For a second mortgage, we are typically anywhere between, I'd say, 12 and 14%.
So a second mortgage means that maybe the bank is in first place, and then we're going to lend more money, but there's so much room in there. We make sure there's so much room in there that we mitigate our risk.
Yeah, we'll look at the individual. How is their credit? What is the situation? Where is the property located? We'll have an appraisal done. We'll do our own analysis.
Yeah.
And you know, does it feel comfortable enough for us to do this? Can we get any other security on? Speaking of real estate,
yeah.
or someone signing as a co-applicant that has good assets. So that's what we do, and then we'll put the package out to our investors and let them make the decision if they want to proceed with the deal or not.
Okay.
And then they can say, yes, I'm comfortable, and they do their own due diligence.
No.
So we basically package the deal, pre-assess it, and then you as a lender would say, you know what, I really like this deal, I'll proceed.
Yeah.
So
and I never have to meet that borrower.
If you want to, you can.
Yeah.
You don't have to.
Yeah, if I want to just keep it, I'm going through profunds.
Yeah.
I don't have to meet that person.
No.
Okay.
We'll provide you with everything, identification, all of that.
Sure.
Each of you will have your own lawyer representing you.
Yeah.
But
so he pays for my lawyer?
And his.
And his.
Yes.
Okay.
Yes.
Good.
And then the mortgage is registered on title. So we'll go up to 85% of the value of the real estate, depending, again, on the big picture.
So
it's not black and white.
No, but if it's a $100,000 property and they need, you know, the bank has already given them a mortgage of $50,000, we will give them another $35,000 because we want to make sure there's $15,000 that's left there for the rainy day.
Yes.
Okay.
You know, and we have stuff in the GTA, Liberty Village. There's a lot of people buying condos down there, investments, and they can only get a certain amount from the bank, so we could top it up, things like that.
So these are the kinds of returns that we can make, and they're just writing a check. There's no perspiration whatsoever. Whenever I talk about investing in real estate, I talk about the 3 different ways. Active investments, that's where there's some perspiration involved. That's talking about actually going out and buying a property and, you know, holding it, buying it, fixing it up, holding it, buying it, doing something to it, flipping it, lease to owns, all that kind of good stuff. That's called active investments. Then we call passive investing, and passive investing is things like syndicate mortgages, private lending, all that kind of stuff. The third way is portfolio investing, where, you know, that can be RRSPs or developments and all that kind of stuff, where there's no cash flow whatsoever. Your money's hopefully just growing at a steady pace.
Correct.
So here we are with passive investments because people want that extra 8, 9, 10, 12, 16% a year.
Yes.
I think it's fantastic. Where there's, you know, could be over 1 million people watching the show right now, Carmen. All over the GTA, from Durham to York to Peel to Toronto, and they're thinking, okay, but where else can I get money? And we haven't even touched on the very first place, and that is the equity that's built up in their home. So talk a little bit about,
incredible.
you know, from a maternal point of view, that it doesn't make sense to do what mom and dad and what mom and dad's mom and dad did and pay off the mortgage, especially at today's interest rates. So talk about it, and I think you're a better person to talk about it than I am, because you do have children. You would advise your own children, do not pay off your home.
Well, I grew up in a very European family, okay?
Yes.
And it was the old school, you know, you have your job.
Italian, no?
It's Austrian, actually.
Austrian, okay.
Yeah, my ex is Italian.
Got
so
it.
there's the clarification there. Everyone always
There
thinks
you
I'm
go.
Italian, but I'm actually Austrian, both my parents. And, you know, it was a strict pay off the mortgage, and, you know, so conservative, the process and thought throughout growing up. And when my parents saw me doing what I was doing, I think they both had a heart attack. Like, they were just losing it over the way I was investing.
Yeah.
And then I got them into it as well. But the interest rates today are so low that people should really be taking advantage of the equity they have in their existing real estate. If it's a rental property, if it's a commercial building, if it's a residential home, your owner-occupied home.
Your very own house that you live in. Yeah.
Take that money and invest it into mortgages. I can get you right now a variable, which I recommend to most, variable rate mortgage at 2.5%, 2.4% interest.
2 points. So it's prime minus, prime I think is 3%. So
Yeah, so prime minus
0.6.
0.7. I'm seeing that right now.
Okay, so let's go through a typical situation. So
Yes.
the average home out there is $500,000, but let's, numbers purposes, let's say $400,000.
Okay.
Somebody has paid off half their mortgage. So they've got $200,000 paid off. How much money, again, from a maternal point of view, obviously it's up to that person, they've got to sleep at night, but how
Yes,
would,
that's
I
true.
mean, I know Jordan, she's a beautiful girl, she's your daughter, she's an adult. How much money would you say to Jordan to have, what percentage of equity should Jordan keep in her personal residence? What would you say? You wouldn't tell her to take it all out if she could.
Well, I would.
No, you would,
I would,
but I'm just saying,
no,
for the
okay.
viewers at home,
I'm saying for the conservative people
Yeah.
that are starting to get into this, that don't want to leverage
I
everything.
think what you've taught me is 20%.
Yes, you're right.
Right?
Yeah, and that's all you can get anyways today. Is
No,
on a
but
refi.
let's say you couldn't.
Right.
Let's say you could get it all out.
Yeah, I would say 75 to 80% would be comfortable, and that's comfortable to me as well when I'm, you know, maybe suggesting something like this.
So we've got this $400,000 property. $200,000 is paid off. I've got to leave in 20%,
Which is
so
80,000.
20% of that 400 is 80,000. So I'll leave 80,000. I have another 120. So you're saying, Rav, I would tell my own daughter, Jordan,
Absolutely.
to take out that $120,000
Yes.
at 2.4%,
Yes.
and then go make money.
Yeah, she could see what's happening is you can take that 2.4%, it's amortized, okay, and then you can invest it in a mortgage, even if we only say 12% to be on the lower end of everything.
Yeah.
So you're making 12% a year on your money, and you're paying 2.4.
Yeah. So let's say I'm paying, make it easy. I'm paying 3%, and I'm lending it at 12%. I'm making 9% on my money on $120,000. I'm basically making 10 grand a year, paid monthly, doing nothing.
Yeah, and
Also,
also
what am I borrowing? What is the monthly on 120,000 at 2.4?
I'm going to give you an example of something I know that's in my
Okay,
mind,
let's-
so we don't
let's
have
do
to try
one.
to figure out the math here. But
Yeah.
I had a client. She had a home that was free and clear. Okay, it was worth over $700,000, which isn't hard to find today. And so we refinanced it. She took $500,000.
No.
Yeah.
Wait a minute.
Yes.
You have a friend, $700,000 house paid off.
Yes.
And with your intellect and persuasion and inspiration, you told her to take out $500,000.
Yes.
So she now has a $500,000 mortgage
She does. So her
at
month.
2.5%.
So her monthly mortgage payments are about $2,500 a month.
Now.
Now.
$2,500 a month, okay?
Yes.
Yeah.
And we've invested her funds, and she is now cash flowing positive after she pays back her mortgage payments every month. $3,000 cash flow a month.
So you put her in an investment with that $500,000.
Yep.
Well, it's nothing sexy, because what you're saying is she took that $500,000 and she's making 12% on that.
Yeah,
So she's making $60,000 a year.
She's actually making more.
Yeah.
But I'm going to use the more conservative
Yes.
approach because she's making 16.
Okay, but let's say 12.
Yes.
So she's making $60,000 a year,
Yes.
which is about $5,000 a month. She's making $5,500 a month,
Yes.
but she's making $5,000 a month, let's
Yes.
say. So she has money to pay off her $2,500
Plus her principal repayment.
plus her principal repayment. So
Yes.
she's paying down the mortgage.
The mortgage is being paid down.
and she's got a free $2,500 a month,
Yeah.
$3,000 a month.
$3,000. Actually, it's more than that. But
Yeah.
in this scenario, I'm just using that to keep it really simple.
So
and
that's a wonderful example. Now, most people would say to her, Susie, they say, Susie, who is this Carmen woman that is telling you to take $500,000 out of your $100,000 property? You're saying this is a woman, Carmen, who's just made me an extra, 40 grand a year that I wouldn't have had.
Yeah.
The average salary in Canada is less than $40,000 a year. And so you've just helped her make a whole full-time salary.
She's making a full-time salary.
By
It's
doing
incredible.
nothing. By doing nothing.
And that's borrowing. Now, we're not just a private lender, we also get bank financing for people. So if people want to get a good rate and want us to assist with that, we can do that too. So ProFunds isn't just private money. We have a commercial division.
Yeah.
We have the residential division, which we have people that are facilitating just that, and they're experts in that area, and they're really good. And then we have the private side, which I work in.
So let's talk about RSP money now.
Yes.
So there's people out there that have $300,000-$400,000 in RSP. So let's use Susie again. She has $500,000 with RSP money. Nothing would have changed here? If she used RSP money, she still would have made this kind of money.
Yeah. Well, you can use your RSPs. Now, I will say that people have to be a little more patient with the RSPs.
Okay. Why?
Well, first of all, there are only selected plans that will, or trust companies that will allow for you to self-direct your funds to mortgage investments.
Now that sounds complicated, but do you do it all for me?
Well, no, because I can't. Olympia Trust is the company we
that's what I mean.
work with. So I will direct you to them.
Yes.
It's not a big job to do, but you have to move them because I'm not allowed to. I don't have your authority to do that, but we will set you up with it. You can contact the person that we deal with at Olympia. We use them. There's a couple of others, but I think right now they're probably the best in the market with respect to being able to facilitate the mortgages that are out there.
And they're just the holder of my RSP.
That's right.
So instead of the big bank holding my RSP.
Yeah, well, actually, they're backed by CIBC, which I found out because people were saying, well, who's Olympia? Like, I'm not going to just give my money to this trust company.
Oh, is that right?
Yeah, so they're backed, actually, it's held in a CIBC bank account, which I found out. So that gives me a lot more comfort, even though they are regulated as well. So, but what happens is your funds are moved then to...
And it still stays in the registered account.
Yes, now they have their own fee schedules. It's not crazy, maybe $150 or something.
No, I'm with Olympia. It's like $150 a year to do this, which is nothing.
Yeah, for what you're going to make. So then, when your money is sitting there, you can say, okay, Carmen, I have $200,000, $50,000, $150,000 in my RSPs, and I'd like to invest in this specific investment.
Yeah.
And then the lawyer, there's a lot more work, and it takes longer to have your funds extracted than cash. That's all.
It's just awesome, and we've covered so much. You're not just a pretty face. Thanks for being here. When we come back from the break, we're going to hear from Carmen's closing thoughts on this whole world of making money with our money. Don't go anywhere. We'll be right back. Did you know that mortgage investments offer returns up to 16% annually, and these returns are not contingent on the success of the project? You, the investor, will receive monthly payments commencing typically 30 days after the funding date. Passive cash flow. Hey, it's Rav. You're watching Real Investments. We've been talking about how to make money with our money in the world of mortgages. Carmen Capernaro's been here. If you've missed the show, make sure you go to rogerstv.com to watch when it's on again this week, because it's been a fantastic one. Carmen, thank you for being here. Look forward to when you come back. I love talking to you each week on the phone. If there's anything that you want the viewers at home to know, and when it comes to lending money, borrowing money, making money, that margin, what would you say? What would you say to them?
I would say don't let fear cripple you, first of all. Secondly, it's not too good to be true. It's been around in the industry for many, many years. And lift up the phone, look into it, find out about it, call our office or someone in our office and gather more information so you know what you're getting into and you can understand it. But it really isn't too good to be true. It is a reality. This has been happening for many, many years. And we've seen the successes of it for a long time.
No, I think well said. I mean, there's nothing proprietary about it. The banks have been doing this forever, so why can't the individuals now get involved and do it? Obviously, knowledge mitigates risk, and so therefore we need to know who to talk to, and so people can go to profunds.ca, give you a ring, all that kind of stuff. You also do live seminars, and that's all posted on the site. So I think that's fantastic, Carmen. I love the fact that you're not only an educator, but you're also a very active investor, that you're actively investing in this deal. So thank you so much for being here.
Well, thank you very much.
And look forward till when we get to do this again. It's always fun. I mean, me and you talk all the time.
Oh, yeah.
But it's great when we get to talk in front of the viewers at home.
Yeah, I love doing that.
Thank you, everybody, for watching the show. Thanks for allowing us into your living room. On behalf of Rogers TV and myself, Rav Tour, we'll see you next week, same place, same time. Honey, I love you. I'll be home soon. Ciao, everyone.